Good evening, everyone. Why don't we get going? It's promptly 6 o'clock, so we'll begin. Welcome to the Knopman Series 24 free review class. Tonight's lecture will go until 7:30 p.m. We'll take a short break, probably for about 8 minutes, right in the middle. But other than that, we'll go straight through. My name is Brian Marks. You see a good-looking picture up here of me on the screen. You see my office phone number, you see my cell phone, and you have my email address. If you have questions at any time about the content, about study strategy, please do not hesitate to get in touch. I recognize a lot of your studying time is on the evenings and on the weekends. I do make myself available during those times to answer questions, so please send me an email, give me a call if you'd like to discuss your prep for the Series 24 examination. We're going to spend a couple minutes talking about the details of the test. We'll spend a couple minutes talking about study strategy. We'll spend a couple minutes talking about how our study resources can help you. But given that tonight's lecture is scheduled for 90 minutes, I don't want to spend too much time there because I want to make sure we can cover all the content. We do have a lot of information on the agenda for tonight. The exam itself is 3.5 hours long, and it's 150 questions. Passing score on the test is 70%. You should have plenty of time to complete the test. Time is generally not a problem on Series 24. You will be given a calculator in the test. It's unlikely that you will actually use your calculator. There's very little math on this examination. The breakdown of the test is that you have 33 questions on investment banking, underwriting, and research. You have 31 questions on equity trading and market making. You'll have 29 questions on brokerage office operations. You will have, that's basically retail account supervision, by the way. You'll have 43 questions on sales supervision, and you'll have 14 questions on financial responsibility. There is a heavy equity bias on this exam. So for those of you who work with fixed income, there's very little fixed income on the test. You'll see a couple questions on trace, maybe you'll see a question on Rule 144A, and that's pretty much it. And that's both good and bad. The bad news is that what you know to be the case from reality won't really apply or help you much on this exam, but that's also the good news because, as you may know, in many cases the way things are in reality may be different than how they're tested on a regulatory exam. So you should know that there's a heavy equity bias. The biggest difference between the Series 24 and other exams you might have taken earlier in your career, let's say Series 7, possibly Series 79, is that the Series 24 knows you're smart. It knows you have some experience in the securities business, and the nature and the difficulty of the questions does reflect that. So what you can't do when you're preparing for the 24 is just run through hundreds or thousands of practice questions and memorize the questions and hope to pass the test. People who do that, what happens is they go in and they take the test. Generally, they do not pass, and they come out and say, I felt like I was taking the wrong exam. It's very, very important for the 24 to learn the concepts. A lot of scenario-based questions on the exam. Just today, I had a conversation with somebody who scored an 85% on the test. Spent a lot of time with the book, also did a fair amount of questions, of course, but spent a lot of time with the book, knew the concepts, felt like there was not anything surprising. Those people who say, you know, I felt like I was taking the wrong test, a lot of stuff that really, to be honest, wasn't covered. More often than not, those are people who maybe did, you know, even 1,500 questions, but read the book once and never looked at the book again. That does not work for Series 24. Very important that you read the material, you understand the concepts. You don't need to go crazy memorizing day counts, how many days you have to file this document, how many days you have to file that document. That is not as important. You have to understand the applications and, in many cases, the exceptions to the rules. How can we help you? Some of you already have our study material. I believe that for the Series 24, we have the best study product out there. The material was recently updated. We added about 50 pages to the text. We have live classes. We have virtual classes in the same format as this. We also have all of our lectures available on demand. So if you can't sit in a live classroom and you can't sit in a live virtual class, we have all of our lectures on demand. It covers literally the same content we cover in our live class. We are also the only training company to offer a full-fledged mobile app. So if you have an iPhone or an iPad, we have all of these lectures on our mobile app. It has flashcards. It also has practice questions. One of the nice things about the app is you can download the content while you're online and then watch it while you're offline. So for those of you who spend a lot of time on the road, meeting with clients or traveling for whatever reason, you can download it. You can watch it on an airplane. You'll get 6 or 7 straight hours of my voice. I think you'll find it soothing, enjoyable, and hopefully educational. The other thing to keep in mind is that all of our content is up to date. A couple key rule changes. FINRA Rule 2210, communication with the public. This rule went into effect 2 months ago. So one of the benefits of working with us and utilizing our content is when that rule went into effect, every one of our students got an email saying, here's FINRA Rule 2210, what you have to know for the test, because literally that information was testable as of, the rule went into effect February 4th, it's effective, it's testable as of February 4th. And we do actually have students who have started to see some of that terminology show up on their exam. So if you didn't have that content, if your vendor didn't send you updated content, you may have some out-of-date information. So you want to make sure you get updated content for FINRA Rule 2210. And that's actually the first thing we're going to go through tonight to make sure you're all up to date on that. The Jobs Act did impact some of the content on the Series 24. Dodd-Frank, of course, impacts everything, including the Series 24. So our content does reflect updated rules, not necessarily rules that are required to be written, but the rules that have been written and have been declared effective either by FINRA or the SEC, because Congress passing a law does not necessarily mean something will go into the exam. FINRA has to pass a rule and it has to go effective, or the SEC has to pass a rule and it has to be effective. There's a question about receiving the slides. We'll go ahead and get you sent over to those. If you could just send me your email address in a chat, I'll go ahead and send those over to you right away. Okay. If you have questions throughout the program, there's a couple things you can do. First, you can type that question into a chat. You can type that question into a chat, and I'll answer it either during the slide or possibly at the end of the slide or when it's appropriate. The other thing that I'm going to try doing for this class to encourage some dialogue is, if you'd like to, there's a raise your hand function. If you raise your hand, I will see that you have a question, and if you'd like to have some dialogue going back and forth, I'll unmute you. I keep it on mute just in case there's any background noise, if you have kids or dogs or some loud coworkers. That way I'll keep it muted. If you have a question, you can raise your hand. I'll unmute you, and you can ask your question. And we can, that way I'm not just listening to myself the whole time. Okay, that being said, we will begin talking about the content. Okay, the topics we're going to cover tonight. We're going to talk about communication with the public first. After communication to the public, we'll talk about some investment banking activities. After that, we will talk about securities and transactions that are exempt from the 33 Act. I'm not going to spend a lot of time on those rules, just a summary, because it's important. I just want to draw attention to it, but to go over it would use up tonight's entire class. Then we'll talk about secondary market trading. Then we'll talk about some regulation NMS rules. And finally, we'll finish with a conversation about investment companies. Investment companies is an area that sometimes people ignore while preparing for the exam, because it's not one of kind of the big 4 areas of customer accounts, sales supervision, investment banking, and equity trading. But investment companies, especially things like levered and inverse ETFs, margin requirements for ETFs, soft dollars, those are things that are showing up on the exam. So you definitely don't want to ignore that in your study material and in your textbook, and when you're doing practice questions, you definitely want to make sure you check out that content. Okay, that being said, we'll get going. First thing we're going to talk about tonight is communication with the public. And again, this is new FINRA Rule 2210. This is new FINRA Rule 2210. This rule went into effect as of February 4th, 2013. It is testable information. There are some things that do, in fact, directly contradict the old rules. So you want to make sure you know the new information. So it used to be that you had all sorts of different categories of communications. You used to have advertisements, sales literature, correspondence, public appearances, and so on and so forth. It used to be 6 categories. Now we are down to 3 categories of communications. 3 categories. You have institutional communications. Institutional communications goes only to institutional investors. Retail communications is any type of communication that goes to more than 25 retail investors. And correspondence goes to 25 or fewer retail investors. So either it's only institutional, or it's more than 25 retail investors, or it's correspondence, which means it's 25 or fewer retail investors. What's the distinction between an institutional investor and a retail investor? Well, an institutional investor, corporations, banks, insurance companies, hedge funds, investment advisors. The general threshold for an investor to be considered an institutional investor is once they have at least $50 million of assets. That's a general threshold for this rule to be an institutional investor. $50 million of assets. Okay, so again, we're down to 3 categories of communications, pretty clear-cut: institutional, retail, or correspondence. Okay. Retail, as you can probably imagine, because it's going to more than 25 retail investors, so that's going to require the greatest level of supervision. Okay. Retail communications require pre-approval by a principal before first use. So it's got to be pre-approved by a principal at the firm before first use. Their principal, you're talking about generally somebody with a Series 24 registration. So that'll have to be approved before first use. If it happens to be a research report, that'll be approved by the supervisory analyst, but that's a less important point. The key thing, retail communications need principal approval prior to first use. Okay, there are some exceptions whereby retail communications can be used without being approved by a principal. The first one is kind of ridiculous. I can't give you possibly an example when it would happen in practice. That doesn't mean, though, that it's not a rule. If another firm has happened to file the communication with FINRA, for reasons we'll talk about in a few minutes, and FINRA did not object to that retail communication, then it can be used by a different firm without being approved by a principal. Okay, so if broker-dealer A files a communication with FINRA and FINRA does not object, broker-dealer B could use that communication without having to wait for principal approval at their own firm. When would that happen? Why does the rule exist? I don't have the slightest idea, but that doesn't mean you don't have to know it for the test. Research reports which do not discuss a particular security do not need principal approval. So, for example, a report that discusses a sector, a report that discusses only technical analysis, that would not need principal approval. Communication in an online interactive forum like a chat room, okay, or a conversation on go-to training like we're having right now, that's an online interactive forum, or a blog. Those do not need principal pre-approval. Now, that being said, if you talk about social media for a second, the static content on a social media website would need approval. Okay, so if your firm has a Facebook page, the static content on that Facebook page would need approval because that's a retail communication. But if you have a blog or a conversation going back and forth, that would not necessarily need approval. Informational items not promoting a product or service. So if you send a note to your clients basically saying Apple stock is paying a dividend, you're going to get a dividend, that does not need principal approval. Now, institutional communications, Okay, I see somebody with a quick question. I'm just going to finish this slide, then I'll take your question. Institutional communications don't necessarily need to be pre-approved. Institutional communications, the firm must establish procedures for review by a principal. You have to establish procedures for review. What does that mean? It doesn't necessarily mean it has to be pre-approved. It just has to be looked at some point. Could be pre, could be post. The firm needs to have procedures. However, that being said, let's say, going to the second bullet point here, let's say you basically prepare institutional communication for a pension fund, but it turns out that that pension fund, you have reason to believe that that pension fund is basically going to start distributing that communication, that market color, whatever it is, to participants, to investors in the fund. Well, now you basically have to treat it as, you basically now need to treat it as retail communications, and that would have to be approved. Okay, Patrick, I see you have a question, so we'll see if this works. I've unmuted you, so hopefully you can ask your question. If not, I'll just ask you to chat it.
Okay, can you hear me?
Yes, I can.
Okay, great. Just, quickly, I guess, on the slide before, the prior slide, the first point, how would anybody know if another firm has filed substantially the same communications with FINRA and received no objection?
Patrick, honestly, I don't have the slightest idea. That's a great question. Okay. Goes back to that bullet point of why does it possibly exist? I don't know. In theory, okay, the rule says basically, in order to avail yourself of this what I think we can all agree is kind of a ridiculous exception, you as broker-dealer B who wants to rely on the approval given to broker-dealer A, you would actually have to get a copy of the no objection letter from FINRA. So if FINRA gave, if broker-dealer A gave you at broker-dealer B the no objection letter, then you could use it. So I suppose that's how it would go, but again, I couldn't give you a real example of this. I'm not aware of it being done.
So maybe a counterpart of mine on the street could say, yeah, we got that, here it is, because we're friends or something.
Yeah, anyway, exactly.
Okay.
Sure.
Okay.
All right.
Got it. Thanks.
Great. I'm going to shut you off again, Patrick. Okay, correspondence. Again, correspondence is anything going to 25 or fewer retail clients, 25 or fewer retail clients. Correspondence, same rules basically as institutional communications. You need to establish procedures for review. What does it generally mean with correspondence? It generally means that you're doing spot checks. So what's an example of this that I'm sure all of you are aware of? Somewhere at your firm, somebody is spot checking your emails. So they don't, all of your emails, of course, are not pre-approved, but somebody spot checks your emails because those are correspondence. Okay, so you basically have spot checks or any type of review procedures. But again, you see the highest level of supervision relates to retail communications. Okay. Now, in some cases, retail communications and other communications will also need to be filed with FINRA. Not only approved by a principal, but also filed with FINRA. New members, what does that mean, a new member? A new member has been a FINRA member firm for 1 year or less. A new member has been a FINRA member for a year or less. New members must pre-file retail communications that are used in public media. So this is your traditional advertisement, TV, radio, newspaper, public domain internet. So those need to be pre-filed with FINRA, and pre-filing, what does that mean? It means at least 10 days prior to first use. At least 10 days prior to first use. Okay. The one exception where you don't have to file it 10 days prior is anything that's defined as a free-writing prospectus, which relates to a securities offering. I'm not going to get too much into an FWP in this review class, but basically if something is considered an FWP, then you can 10-day post-file it, because it wouldn't necessarily be practical to file it 10 days before. FINRA, if they want to, can require a member firm to file all communications or certain communications for rules violations. So if there was a failure to supervise or something negligent, they can basically say, you basically need to file everything. Okay. Moving on to pre-filing, with other products. So communications regarding certain products. So you have all communications, no matter if you've been a member firm for 1 year or less or 1 year or more. Registered investment companies with performance rankings that are not generally published. So what I kind of call homegrown or independent performance rankings. So if it's a non-independent rather. So if it's not a performance ranking by a Morningstar or a Barron's or a generally recognized. So if you have an investment company communication with kind of a homemade performance ranking, it has to be pre-filed. Communications regarding securities futures need to be pre-filed. And communications regarding bond mutual funds with volatility ratings need to be pre-filed. Okay. So that's even if you've been a firm for more than a year. It's got to be pre-filed. There's a question regarding is that 10 days going to be business or calendar days? That's going to be 10 business days, but almost never on the exam is the distinction between business and calendar days important. Not something you need to worry about for the test. Ooh. Okay. There are other communications that are required to be post-filed. Other communications need to be post-filed. Okay. What does that mean if a communication needs to be post-filed? It means it can be filed up to 10 days after first use. So it's got to be filed with FINRA, but up to 10 days after first use is okay. Registered investment company communications that were not pre-filed, so something with a legitimate performance ranking, like a Morningstar ranking. It doesn't have to be pre-filed, but it still has to be post-filed. Communications concerning DPPs, direct participation programs, like limited partnerships. Communications regarding CMOs, and by the way, this one is important, because CMOs used to be pre-filed. Under the old FINRA rule, they were pre-filed. Under the new FINRA rule, they are now required to be post-filed. That's important. Templates for investment analysis tools. Templates for investment analysis tools like a retirement plan calculator or a college tuition calculator or a mutual fund calculator. Also, communications concerning structured products like exchange-traded notes, options, other derivatives. Those, again, need to be post-filed. Okay, so again, you have new members need to file effectively advertisements at least 10 days before, and all members have to file certain retail communications related to certain products either at least 10 days before or within 10 days after, again, depending on the product. Okay, any questions on that FINRA Rule 2210, that communications with the public rule, before we move on to another topic? And again, that's all from a new rule. That's not the extent of the entire rule. Again, in the limited amount of time, I want to give you the highlights, what's most important for the test. There are some more specifics there, so you just want to make sure that you have updated information before you go into the test. Okay. I'm not going to spend a huge amount of time in general tonight on investment banking, because a lot of that stuff comes down to rules, and in prioritizing what I think will be most useful, I want to prioritize where I believe this lecture can add value. What I do want to talk about is a shelf registration. A shelf registration, continuing at the bottom of top of page 9, shelf registration allows an issuer to pre-register securities. Shelf registration allows the issuer to pre-register. It basically means that you can tee up a deal, and that way as soon as the market is receptive, you can sell the securities. Because if you wait to start to register until the market is favorable, by the time you're done with the registration process, you might have missed your opportunity. It's generally good for 3 years now. Smaller issuers is still going to be good for 2 years. It can be used for both equity and debt securities. However, it cannot be used for IPOs. It can be used for equity and debt securities, but not IPOs. These rules vary depending on the type of issuer. A few years ago, the SEC defined a new type of issuer known as a WKSI, a well-known seasoned issuer. WKSI has either a $700 million non-affiliate market cap or has issued at least $1 billion in non-convertible debt in the last 3 years. At least $700 million market cap, basically your public float, or, and that's an or test, or has issued at least $1 billion in non-convertible debt. One additional note you may want to make is that they also must have been an SEC filer for at least a year. So a huge company that goes public today, well, you still can't be a WKSI for at least a year. You got to be an SEC filer for at least 1 year. Now, WKSIs, you don't have to write this next number down, but WKSIs account for 95% of the capitalization of the equity markets. And before this rule existed, a company like Google, which clearly is a WKSI, when they wanted to sell securities, they had to file a registration statement with the SEC. It was 600 or 700 pages. And basically, the SEC was pretending like, what's this company, Google? We've never heard of Google before. We need to see all your financials, the purpose of your business. Even though you've been an SEC filer for 10 years, we need to know everything about you like we've never heard from you. Well, that's a waste of everyone's time. So WKSIs are granted some relief. And this is on the next page. The relief they're granted is in the form of an automatic shelf registration, an ASR, an automatic shelf registration. What does that mean, automatic? It means that the registration statement is effective immediately without SEC review. It means the registration statement is effective immediately without SEC review. So you basically hit submit, you file it, and it's effective right away. Again, keep in mind, you can't do this for an IPO, so it wouldn't apply for an IPO. Remember, you can't shelf-register an IPO. And then every 3 years, you just update the filing. Filing fees are paid by a WKSI. Also, it's called pay-as-you-go. Pay-as-you-go. Which means you don't actually have to pay until the securities are sold. And also, WKSIs can use an FWP, a free writing prospectus, at any time. What does that mean, an FWP? It allows the issuer to use written communications besides the full prospectus. You can use written communications in addition to the full prospectus. It used to be that you could only use the full prospectus, 600, 700 pages, however long it was. Now you can have other written communications, like a term sheet or a sales memo. An online roadshow, those are filed as FWPs now. And you just file it, so that way it's filed with the SEC and every investor can see it. Seasoned issuers are smaller. Seasoned issuer has at least a $75 million float. $75 million float, so much smaller. Seasoned issuer gets a non-automatic shelf. What does that mean, non-automatic? It means it is reviewed by the SEC. You get a non-automatic shelf, so it is reviewed by the SEC. Filing fees are paid up front. Unlike WKSIs that can pay filing fees pay as you go, seasoned issuers have to pay filing fees up front. Also, a seasoned issuer can use an FWP, but only after a registration statement has been filed. So a seasoned issuer can use an FWP, but a registration statement must be on file beforehand. Whereas a WKSI, a well-known seasoned issuer, can do it whenever they want. Ineligible issuers, what does that mean? Ineligible issuers include companies in bankruptcy in the last 3 years and blank check companies like SPACs. What does that mean, a SPAC? A SPAC is a special purpose acquisition company. This is kind of an oxymoron, I know, but that's basically a public-private equity firm. It's basically a firm that, rather than a private equity firm, raises money privately from institutional investors. A SPAC, or wealthy individuals, a SPAC will do an IPO to raise the funds. And they have no purpose other than eventually they're going to buy another company just like a private equity firm. And if they don't, then they give the money back. What does it mean to be ineligible? It doesn't mean they can't sell securities. Otherwise, the SPACs would be out of business. Ineligible issuers cannot use a free writing prospectus, and they cannot do a shelf registration. Ineligible issuers get no free writing prospectus and no shelf registration. Moving on to exemptions from the 33 Act. I'm not going to spend a lot of time on this. I'm really going to just highlight it because this is an important concept, but this concept alone would take up 75% of tonight's lecture. So I want to highlight it as an area that you need to study on your own. Now, what does it mean for a security to be exempt? Exempt means exempt from registration. Exempt securities are not required to be SEC registered. Exempt securities are not required to be SEC registered. Exempt securities include U.S. government and government agencies, municipal bonds, commercial paper with a maximum maturity of 270 days. It's basically short-term debt. Also, securities issued by commercial banks, but not securities issued by investment banks or bank holding companies, just regular, plain old commercial banks, of which there are really none left. But securities issued by commercial banks are basically exempt from registration. And also securities issued by a nonprofit, those are also going to be exempt. Okay, so again, this is an important topic. And then you have a whole big list of exempt transactions. And again, I'm going to highlight them here as things you need to study, but not the most efficient use of our time to go through them all together. So you have Regulation A, which is intended for small businesses. You have Regulation D, which is a private placement. You have a Regulation S, which is an overseas offering. You have Rule 147. That's for an intra-state offering. Pretty uncommon in practice. You have Rule 144, which permits the sale of restricted stock. And you have Rule 144A, which is for QIBs, qualified institutional buyers. And of these, for those of you who work in fixed income, you probably know 144A Reg S deals are fairly common. So again, you definitely want to spend some time studying these regulations. Okay, let's move on to the secondary market. And we're going to spend a fair amount of time talking about secondary market trading, some of the more detailed rules. Because equity trading, for those of you who are not equity traders and don't work in equity trading, this is generally the hardest area of the test. This is probably the area of the exam you're least familiar with. You have all sorts of technical trading systems that can be challenging to understand. And we're specifically tonight, we're going to talk about Nasdaq, and we'll talk about some Reg NMS rules. Nasdaq is a three-tier market. You have the Nasdaq Global Market, you have the Nasdaq Global Select Market, and you have the Nasdaq Capital Market. You have the Global Select, you have the Global, and you have the Capital Market. Global Select Market is your largest, most highly capitalized, most liquid Nasdaq stocks. So your Googles, your IBMs, excuse me, not IBM, that's on the New York Stock Exchange. Your Googles, your Apples, your Facebooks, those are all global select market stocks. Then you have the global market, which is the middle tier. Then you have the capital market. Then you have the capital market, which is the bottom tier of Nasdaq. And these differ based on listing criteria. And by the way, as an investor, you don't care which tier a stock is on. It's just a reputational thing for the issuer. And these differ continuing at the next slide. These differ based on listing criteria. Okay, so Nasdaq will examine a company's financial profile to determine which tier it qualifies for. Okay, so they examine their capital requirements, they examine their assets, their shareholders, their shares, their bid price, number of market makers. Couple numbers you might see on the exam. And what's nice about the numbers that they might test you on is that they happen to be the same for all three tiers. So you don't need to worry quite as much about knowing the difference between the tiers. So for initial listing, an issuer is required to have at least a $4 bid price and 3 market makers. For initial listing, you're going to need to have at least a $4 bid price and 3 market makers. For continued listing, an issuer is required to have at least a $1 bid price and 2 market makers. So you need a $4 bid price and 3 market makers for initial listing. You need a $1 bid price and 2 market makers for continued listing. Okay. And what is the role of a market maker? Well, the role of a market maker in general, and you can take these notes on the next page, the role of a market maker is to provide liquidity. A market maker, a cash equities trader, a cash equities market maker provides liquidity. Okay. So basically, a market maker has an inventory of stock and stands ready to trade the stock at all times. Nasdaq market makers are also required to satisfy net capital requirements. The net capital requirement for a market maker is a function of the number of names that it quotes. And here's how this works. For every stock bid less than $5 a share, net capital is $1,000 per name. For every stock bid less than $5 a share, net capital is $1,000 per name. For every stock bid more than $5 a share, net capital is $2,500 per name. So less than $5 is $1,000 per name. More than $5 is $2,500 per name. The minimum from this requirement is $100,000. And the maximum, so even if a market maker makes a market in 3 stocks, it's still $100K. The maximum is $1 million. So if you're quoting, 2,500 stocks, it's still $1 million. So you multiply it out, you add it up, it's got to be between $100K and $1 million. All Nasdaq quotes by rule are going to be firm, 2-sided quotes. All Nasdaq quotes will be firm and 2-sided by rule. What does that mean if you're firm? It means you have to be willing to trade. Okay. You can't back away as a market maker on Nasdaq. You have to be willing to provide liquidity. Okay. 2-sided. 2-sided, it means you got to have a bid and an offer. There's a question about what does that mean when I say net capital. Is your question about the capital requirement for a market maker or your capital requirement to be listed on Nasdaq, Shay? As a market maker, so there's a whole, the question is what does it mean? When I say net capital, what does that mean? And this is also tested on the exam. We're not going to go through it tonight because to be totally honest, the calculations are testable. I don't really see them show up that much. Net capital is a measure of the firm's liquidity. So the general calculation for net capital is you start with the firm's net worth, you add in what are called subordinated loans, then you subtract your illiquid assets, such as like real estate, exchange memberships, hedge funds positions, and then you haircut your securities positions. So you start with your net worth, you get rid of illiquid assets, you take a haircut on the securities you own, and that's your net capital requirement. Okay, so you can review that in the text that you have, but that's the general idea. Hopefully that answers your question. Okay, trades need to be reported within 30 seconds of execution. They'll either be locked in. Locked in means it's reported automatically, or it'll be reported into ACT, A-C-T. It'll be reported into ACT. And ACT is just trade reporting software. Market makers have an obligation to provide a fair and continuous market. They have to be willing to trade the stock. You can't just stop quoting the security. You have to be willing to provide liquidity. However, you could have an excused absence, like a hall pass. What are some acceptable reasons? Well, if investment banking activities, like if you have non-public information about a merger, equipment failure, vacations or religious holidays. Vacation, however, is only an acceptable excuse at a small firm. A small firm is a firm with 3 market makers or less. So if you work at a company with 50,000 employees and you go on vacation for a week, despite your importance to the firm, they're going to have to survive without you and continue to quote the stock. Unexcused just means the market makers lost a lot of money that day. They don't want to trade anymore. You don't know which way the stock is going to go. They just stop quoting the stock. Well, an unexcused absence, also called a voluntary withdrawal. You got to be careful because voluntary makes it sound like it's okay. It's not okay. But if you're voluntary or unexcused, the market maker has to sit out of that particular stock for 20 business days. You cannot make a market in that particular stock for 20 business days. So again, if you can have an excused absence, you can get permission for up to 5 days. If you're unexcused, you got to sit out of the market in that stock for 20 days. Any questions? Okay, it's now 6:42. So we're going to take a break. We're about halfway done. We're going to take a break for 8 minutes till 6:50, just a short break tonight since we only have about 40 minutes left. We'll take an 8-minute break till 6:50, then we'll continue on. Okay, it's now 6:50. I'm going to start talking again, so if you can't hear me, hopefully you just saw my chat and you let me know, but it should be coming through. Now we're going to talk about Reg NMS, and what's the plan for the rest of the class? We really have 2 major units left. Reg NMS, and then we're going to talk about some investment company information, and the goal always is to leave about 10 minutes to questions. If there are other topics where you're studying, you're having difficulties with, that would be a good opportunity to discuss those items. What is NMS? National Market System. You don't have to know what it stands for on the test. That's what it is. Reg NMS in general, it went into effect a couple years ago. In plain English, it kind of means that the SEC acknowledged that people actually trade stocks electronically, so it updated the nature of equity market trading regulations. It updated equity market trading regulations. Two NMS rules we're going to talk about. This is on the next page of your packet. The first one we're going to talk about is limit order protection, or the Manning rule from a class action lawsuit. It's not your favorite Manning. It's not Eli or Peyton or whoever's having the better year. It's an old class action lawsuit. Well, limit order protection basically says that if a firm, as you can see the first bullet point, if a firm executes a trade for its own account at a price that would satisfy a customer's order, if a firm trades for its own account at a price that would satisfy a customer's order, the customer's order must be filled within 1 minute, and as you can see, it must be filled for at least the same number of shares. It must be filled within 1 minute for at least the same number of shares. And we're going to go through examples in a second. So if I'm a market maker, I trade for my own account at a price that a customer would accept. I have to fill the customer for as many shares as I took for myself. And if you execute as a better price, you got to give the customer that price improvement. For example, now we are in the middle of the page. It might be helpful for those of you who don't have me at the front of your screen. You might want to just bring up the next couple slides because you'll see some animation here. You'll find it helpful. So market maker A is holding a customer's order to buy 500 shares at 20.05. You're holding a customer's order to buy 500 shares at 20.05. Market maker A then receives a market order to sell 800 shares. So let's assume that when that market maker receives that order to sell 800, it buys 400 for itself at 20.05. So market maker A buys 400 for itself at 20.05. Well, if it buys 400 for itself at 20.05, the customer was willing to pay 20.05. So what does it have to do for the customer? It's got to fill the customer on 400 shares. So the obligation of the customer would be 400 shares at 20.05. Doesn't have to fill the customer first. It just has to give the customer as many shares as it takes for itself. How about if market maker A buys 400 for itself at 20.04? Second scenario. Market maker A buys 400 for itself at 20.04. Well, is the customer bidding at 20.05? Are they willing to pay 20.04? Sure, absolutely. If you're willing to pay 20.05, you'd be willing to pay 20.04. So the obligation of the customer would be 400 at 20.04. You'd have to pass along that price improvement. And finally, what if market maker A buys 400 for itself at 20.06? Was the customer willing to pay 20.06? No, customer's not willing to pay 20.06. Customer's willing to pay 20.05. So the obligation of the customer there would be none. There would be no obligation of the customer because the customer is not willing to pay 20.06. The customer is only willing to pay 20.05. Any questions on this? Okay, great. What are some exceptions? Trading along here, it's kind of a misnomer. Trading along, what does that mean? It basically means that the market maker can trade for its own account without executing a customer's limit order at all. You can trade for your own account without executing a customer limit order. In order to do this, you have to provide clear notification at account opening and annually, or verbal disclosure before the trade. And at that point, the customer can basically say, F you, I'll take my business elsewhere, and that's fine. But you have to provide notification at account opening and then annually. Or you can provide disclosure before each trade. And even then, even when you make the appropriate disclosure, you can only trade along in two cases. In practice, by the way, you sometimes hear the term TAOK, trading along OK. That's a term you hear in practice, TAOK. It's permitted for institutional accounts or for orders of at least 10,000 shares and 100K in value, basically block trades. So 10,000 shares and $100,000 in value, you can trade along, which means as a market maker, you can execute your own trade first and worry about a customer sometime later. Not only are customer limit orders required to be protected, continuing on the next page, customer limit orders are also required to be displayed. What does that mean? It means when a firm gets an order from a customer, it is required to update its quote to reflect the customer's order. When a firm gets an order from a customer, it's required to update its quote to reflect the customer's order. And how long do you have to update your quote? You have 30 seconds. 30 seconds to update your quote. What are some exceptions? If the customer says DNS, do not display, or DNS, do not show. Other exceptions, if the order size is less than 10% of the market maker's current quote size. I'll talk about that one more in a minute. Other exceptions would be for an odd lot. An odd lot is an order for less than 100 shares. Or a block size order. Block size is defined differently for this rule. Block size here, unlike limit order display, limit order protection is $100,000 in value. This is 10,000 shares or $200,000 in value. And then you have an all or none where the customer says, I got to get the whole thing, otherwise I don't want anything. Okay, these are exceptions where basically you do not need to update your quote to reflect the customer's order. So let's talk about some examples here. In the middle of your page, you see a typical Nasdaq screen. The 3 columns on the left relate to the bid. The 3 columns on the right relate to the offer. And you see it says market maker A, market maker B. Those are market makers. In reality, it would say GSCO or MSCO or BCAP or FBCO for First Boston or JFRS for Jeffries. You could figure out who the market maker is by their ticker. And you can see the shading changes where the price changes. So market maker A is bidding 1042 and they're willing to buy up to 2,200 shares. Market maker B is bidding 1042 and is willing to buy up to 2,600 shares or 26 round lots. And then you have another Nasdaq quote. We don't care what that means for purposes of this lecture right now. It's for 3,500 shares. Then you see the shading changes where the price changes. So a penny away, you see at their best bid, market maker A will buy 2,200. Well, a penny away from that at 1041, they'll buy another 1,800. So one of the nice things about Nasdaq is that it shows the depth of the book. This is what depth means. It means for market maker A, it shows their best price, and also a penny away from that. And you see on the offer side, market maker B is offering 1044 for 2,700. The Nasdaq quote is for 2,400, and a penny higher, market maker A and market maker B are offering the 1045. Okay. So I'm going to talk about the examples at the bottom of your printout, but I'm going to stay up here on the screen. So first example, market maker A receives an order to buy 1,000 shares at 1042. They receive an order to buy 1,000 shares at 1042. The question, how would they update their quote to reflect that order? Well, market maker A, I'll bring up a pen here. You can see here they want to buy right now at 1042, 2,200 shares. I apologize for my horrible penmanship. Customer wants to buy another 1,000 shares or 10 round lots. So what would happen to market maker A's quote? It's still a 1042, but now it's for 32 round lots. So it'll be 1042 on 3,200 shares. Second example, market maker A receives an order to buy 1,000 shares at 1043. Well, this improves their price because they wanted to buy at 1042, but now you have a customer who comes in at 1043. So what happens? Well, all of these bids slide down a row, and right here, you would have a new bid on top. And it would say MMAA 1043 for 10 round lots. So the 1042 bid on 2,200 would still be there, but now you have a new best bid. Third example. Market maker A receives an order to buy 1,000 shares at 1044. Well, this one's a little tricky because market maker B is actually offering a 1044. So market maker B, their size would decrement from 27 to 17. So market maker B, that's actually what's called a marketable order. What does that mean, marketable? That means the order can be filled given current market conditions. It means the order can be filled given current market conditions. So that order to be filled. So market maker B would fill 27. They're offering 2,700. They'll fill 1,000. So now they're still offering 17 round lots. One more example. Market maker A receives an order to buy 100 at 1042. Well, that one's a little tricky too, because normally you'd say, well, shouldn't they update their display size? Well, actually they wouldn't, because that's less than 10% of their current quote size. You see, they wanted to buy 2,200. Well, 100 shares or one round lot is less than 10% of that, so they would not need to display that order. They would not need to display that order. Any questions on this concept? Again, the key thing is you have 30 seconds to display, and going back to the previous page, if it triggers a Manning rule, limit order protection, you have 60 seconds to trade. So 30 seconds to display and 60 seconds to trade. Okay, in the final unit, and then we'll have maybe 10 or 15 minutes for whatever questions or any other topics you want to talk about, maybe you were confused by. I want to talk about investment companies. 3 general types. You have face amount certificates, which don't really exist much anymore, so you don't have to know much about them. You have UITs, a unit investment trust. A UIT is a fixed portfolio of securities. It's a fixed portfolio which is supervised, but which is not actively managed. It's a fixed portfolio which is supervised, but not actively managed. Then you have 2 types of management companies, which I'm going to talk about now. You have an open-end fund and a closed-end fund. You have an open-end fund and a closed-end fund. Continuing at the bottom of the page with an open-end fund. An open-end fund is the same exact thing as a mutual fund. The terms open-end fund and mutual fund are synonymous terms. Exact same thing as far as we're concerned for the test. A mutual fund registers a continuous offering of redeemable shares. A continuous offering of redeemable shares. What does that mean? It means the shares can only be purchased directly from the fund or sold back directly to the fund. So you want to buy shares of a Fidelity mutual fund, Fidelity Magellan, for example, you got to buy them from Fidelity. If you want to liquidate your position, you got to sell them back to Fidelity. There's no secondary market. Put another way, there's no such thing as making a market in mutual fund shares. Mutual fund shares are not marginable. They must be purchased in full. However, that being said, after a 30-day holding period, they do have what's called loan value. So after 30 days, they can be pledged as collateral for a loan. Also, mutual funds only issue common stock. They don't issue preferred stock. They don't issue debt. They only issue common stock. How are mutual funds priced? Continuing on the next page. You definitely want to know this for the test. Mutual funds are priced and sold at what's called the public offering price. This is a calculated value. How is it calculated? It's calculated as the net asset value, the NAV, plus a sales charge. It's the net asset value plus a sales charge. So it's calculated. That sales charge is a maximum of 8.5% of the public offering price. However, many mutual funds offer what are called breakpoints. Okay, what does that mean, a breakpoint? A breakpoint is a discounted sales charge. It's a discounted sales charge based on the amount of money invested. It's a discounted sales charge which is based on the amount of money that's invested. So, for example, if you purchase up to $25K, you might pay 8.5%. 25 to 50, you might pay 6%. 50 to 100, you might pay 5%. Eventually, 500K or more, you might pay no sales charge at all. So that's what's called a breakpoint. By the way, It'd be a violation to sell shares just below a breakpoint. If you tell an investor, hey, you should purchase, 49K of this fund with a breakpoint of 50, that's a violation because you're juicing up, you're trying to generate a higher sales charge. The investor would be better off investing 50K. A letter of intent. What does that mean, a letter of intent? A letter of intent basically allows an investor to purchase mutual funds in installments. It allows an investor to purchase mutual funds in installments to achieve breakpoints. So you don't have to invest everything at once. And you can invest in installments over 13 months. You can invest in installments over 13 months. So you can invest, let's say, $10,000 now, but pledge to invest 50. And because you're pledging to invest 50, you get the lower sales charge. Rights of accumulation allows an investor to aggregate positions across accounts. So, for example, if you have an individual account and a joint account with your spouse, you could aggregate those investments to get a breakpoint. Continuing in the middle of the page, Class A shares. There are some mutual funds left that offer both Class A and Class B shares. To be totally honest, there aren't that many, but there are a few. A shares offer a front-end load. What does that mean, a front-end load? It means the sales charge is paid up front. Front-end load means you pay the sales charge up front. But because you pay the sales charge up front, the benefit is that they offer breakpoints, so that discounted sales charge. So as a result, they offer breakpoints. Also, because of that, they have lower 12B1 fees, 12B-1. 12B1 fees. What are 12B1 fees? Those are your annual expenses as a percentage of your investment. So if you own mutual funds and every year at the end of the year you notice that, let's say, you pay 30 basis points, those are your 12B1 fees. And they're lower for Class A shares. They're for general and marketing and administrative expenses. Class B shares have a deferred sales charge, so you pay the sales charge at the end. But because of that, you don't get breakpoints, and you're going to pay higher 12B1 fees, higher annual expenses. Also, soft dollars. Soft dollars is kind of an interesting concept. Soft dollars basically is a situation where mutual funds and other trading clients, like in theory investment advisors, will basically pay for broker-dealer services by giving them trading business. So they pay for services like research or computer software by directing commission revenue their way. The best way I describe it, the way I like to describe it, I call soft dollars frequent flyer miles. So basically a mutual fund directs trading business to a firm. A mutual fund will direct trading business to a firm, and in return they'll generate frequent flyer miles, soft dollars, just like you do when you fly, and they can then use those soft dollars to get things like research. They cannot be used to pay for computer hardware or travel, but they can be used to pay for things like research and seminar registration. Not travel to get to that seminar, to that boondoggle, but the registration fee. Questions? Moving on next to ETFs, Exchange Traded Funds, ETFs. ETFs are technically what are called closed-end funds. Closed-end funds. What's the difference? Well, a closed-end fund trades publicly. Closed-end fund will trade publicly. So just like common stock, you have a one-time IPO, and then you have an active secondary market. Now, ETFs specifically are supervised, which means they generally replicate an index, but they are not actively managed. Like the spiders will replicate the S&P 500. They will replicate the S&P 500. These are very, very popular investments. You also have what are called levered ETFs. What does it mean if an ETF is levered? It means it seeks to return a multiple of the index. It doesn't guarantee that return, it just seeks that return. So you might have an ETF that seeks to return 2 times the S&P or 3 times the S&P. Might not achieve that, but it seeks to achieve that. The inverse ETFs seek to return the opposite of the underlying. So you might have an ETF that seeks to return the opposite of the S&P. So if the S&P goes up, the inverse ETF will go down, or what you're hoping for is if the S&P goes down, the inverse ETF will go up. Suitability is very important for these products because they don't seek that return from now until the end of time. So to tell a client, if you buy an inverse S&P ETF 2 times, it can be a leveraged inverse ETF, like an ultra short. So if you buy an ultra short S&P, you'll get 2 times the opposite of the S&P from now for the next 10 years. That would be totally false because they have a reset period. They seek that return over a day or maybe a week, but generally a day. So suitability is very, very important here. Very easy for individual investors to misunderstand what it means to have a levered or an inverse ETF that will achieve that return from now until forever. Very, very important. Okay, so again, suitability is key for these products. Okay, margin accounting, we're not going to talk about tonight. Why aren't we talking about margin accounting? To be totally honest, very lightly tested on the exam. For those of you kind of in the throes of studying, basically, probably spend a lot of time debits, credits, SMA, Reg T, all that kind of stuff. You might have 1 question on margin accounting, maybe 2. In general, again, they give you a calculator on your test. Very unlikely to use it. Most people don't use the calculator even once. So they will give you a calculator, probably not going to use it. They do test this notion, though, of margin requirements for ETFs. And here's how this works. For a long ETF, minimum maintenance is 25% of the market value, just like it is if you buy a stock. For a long ETF, it's 25% of the market value. For a short ETF or an inverse ETF, it's 30%, just like if you are short stock. For an inverse ETF, it's 30%. Okay. Now, if it's levered, though, if the ETF happens to be levered, the leverage has to be multiplied by the requirement. The leverage will be multiplied by the requirement. So, for example, let's say you have a long ETF with 200% leverage. Well, normally it would be 25%, but because it's 200%, it's 200% times 25%, so it's 50%. Minimum maintenance would be 50%. How about a short ETF with 200% leverage? Well, normally it's 30% because it's an inverse ETF, but because it's 200% levered, it would be 60%. So again, if it's a levered ETF, you got to multiply the leverage by the requirement. Okay, so again, that, and truthfully, that's pretty much the extent of the math you'll see on the test. In general, very little math on the exam. Okay, that's pretty much all I have for the planned content. A couple things. Can you do me a favor and raise your hand if, just choose the raise your hand function if you're using my study material, if you have a Knopman textbook, things of that sort. Okay, a couple people. Okay, now I'm going to clear the hands, and can you raise your hand if you have textbook study material from another vendor? Okay, so about half and half, and some of you didn't raise your hand at all, which means either you're not paying attention or maybe you're deciding where to get material from. For those of you who have my material, again, you got to thoroughly read it, and truthfully, if you have another vendor's material, you have to thoroughly read it. You want to use my lectures. If you are not using my material, my goal is not to say, well, you should drop the material that you have. It very well could be reputable. There are a number of reputable vendors. Their study material is just fine. Where I think we can add value is in the quality of our instruction. I hope you found tonight's lecture useful. Our overall lecture, our class, our on-demand lectures between 8 and 10 hours for the Series 24. I think you'll find that useful. If you think you'd like to supplement the material you already have from another vendor, what you may want to consider doing is getting our digital-only package, which is the cheapest one. You can buy it on our website. You can buy it on your mobile device as an in-app It'll include all of my lectures. It's my voice. You'll get more sick of my voice. You'll hate my voice more than you do just now, and you've only been listening to me for less than 90 minutes now. It includes, we have about 500 flashcards, which as of now are available on the mobile device only. They'll be coming to our website within the next 6 weeks, pretty much by the end of this quarter, I'd say. Also, you'll have some practice questions on the mobile app as well. So again, if you'd like to take advantage of some of our stuff without really having to break the budget and go out and effectively duplicate your costs of materials, which I am cognizant of, you can certainly consider using that portion, that feature of our site. If you have questions, of course, about our content, about our materials, you can give our office call at any time. Okay, so it's now 7:20. I want to leave a couple minutes to answer questions. So if you have a question about a topic, something we've discussed, that's fine. If it's a question about a different topic on the Series 24, that's just as good. If it's a topic that you ask and it's not on the Series 24, I'll let you know because I know everybody's here. Not to get smarter, just to learn to pass the test. You can ask your question by sending me a chat. That's one choice. You can also ask your question by raising a hand, and I'll unmute you. One more comment I do have before everybody hops off. You're going to get a survey from me after tonight's class, just encouraging you to give feedback about what you thought about the program. I would appreciate it if you would respond to that survey. It's 10 questions. It'll take you about 15 seconds to complete, so that would be helpful for me. I would very much appreciate if you would review that survey. Now, that being said, what questions do you have? Like I said, you can type it in. You can raise your hand, and we can have a chat, and I can hear back from one of you. Really, whatever you'd like to ask. So far, I have no questions. Everybody's shy. Okay. Well, if nobody has any questions, I guess we'll call it a night here. Like I said, if you'd like to have a conversation offline, send me an email. Give me a call in the office. I'll be in the office tonight, actually, so if you want to call me and have a conversation immediately after this class, you can certainly do so. You see my number right up there on the screen. Beyond that, like I said, if I wish you all the best of luck on your exam. I hope you found tonight's review helpful. I anticipate we'll be holding another virtual review for Series 24 sometime maybe late this quarter or maybe sometime early in the third quarter. Beyond that, I hope everybody enjoys the spring. If you're out in the Midwest somewhere, stay safe in that weather. And thanks very much, everyone. I'll speak with you soon.